All right, folks, welcome back. This is our Monday, August 1st, 2022 market review. And I'm going to cover some brief commentary, obviously, not in very great detail, obviously, but I want to teach you a little bit about how I use the tools that I teach my students here on this YouTube channel and provided the commentary and analysis that you saw pan out in your charts last week. So it's a little bit of a advanced study, but I think you'll find it interesting. Before we get into that dollar index, we're only going to be working with the daily charts. So obviously we saw it drop down into the area we were looking for last week. One of the levels I have an interest in is if we get below here, we might retrace in here. So I'm aware that that may happen. So just take this with a grain of salt, but I'm siding with it likely to go a little bit lower. If it does go below here, focus in on this little area right there. Okay, and if it gets there, that might be just a speed bump just to clear some of this sell side. Euro dollar, I think this one still wants to go higher. I'm favoring the run up into this area here. So we have sell side imbalance. This is an old low. It might want to gravitate back to that, but I'm just more interested just to get in this area here and run some buy side liquidity out. British pound, we had this one deliver as we were expecting last week. So we traded up into that. We have buy side liquidity here. Watch this old imbalance. So we have sell side imbalance there. Buy side here. So just watch the bottom of that old imbalance there. That might be noteworthy going forward into the rest of this week. So far everything looks solid on the upside. So any retracement should be viewed as another run up into this area here. That's how I would interpret it. E-mini S&P, daily chart, September contract. We have price run above this short-term high here. So last week I gave you an objective of 12,973 3/4. And if we continue to go higher, my focus is here. Okay. Today was a rather soft day. It doesn't really have a whole lot of volatility. I was able to participate in the afternoon session, and you can check that out on Twitter. There's no need for me to put it here. But the fair value gap associated with this order block. So this candle's high, this candle's low. There's the fair value gap. He trades down into that and into the order block. Okay, trades into that, tears off higher. I mentioned that we had an SMT divergence here at the time of this daily candle in the reviews last week. I said that would be temporary. I felt it was going to go higher, and we did. So it's important to know that just because you see what I'm teaching conceptually as an SMT divergence, that being the E-mini S&P was making a higher high on this very day versus the NASDAQ failing to make a higher high than that of that candle here. So respectively, if you look at the relationships between the E-mini S&P daily chart and the daily chart shown here, not looking at this candle yet having formed, I mentioned that there's a short-term SMT divergence, but don't look at that as a top or a shorting opportunity, as we would be drawing up into the buy side liquidity here. And we got that into last week. E-mini S&P, daily chart, September delivery. And we're going to talk a little bit about this one because this is where I more or less did all the work with futures trading last week. We had the remainder of this imbalance. I mentioned that initially we got up into that, and then I gave you this imbalance last week. Fair value gap, we dropped down into that, rallied into the low of that fair value gap, and then rallied all the way through and completely closed in and repriced back to the high of that fair value gap. And on Friday, we went a little bit further through, and then today we opened, came back down into that level, and just a really small range. I want to talk a little bit about why you probably had some difficulty this morning trading, or this entire day trading, the index market. In your notes, record this. August is typically one of those months that have a lot of uncertainty because there's a lot of disinterest in equities because it's the last month of the summer. There's a lot of folks that are going away. There isn't a lot of participation in the marketplace. So therefore, volume will be a little bit lower than typically you will see in spring and fall. Noting that, it's important that you have in your plan or your approach or model to not try to do a lot of trading in August as a general rule of thumb. You're going to see me do very, very little this month. In fact, this week, I'm probably going to do next to nothing. We have non-farm payroll Friday. We have summer doldrums month of August. I'm planning a vacation for 2 weeks. So I'm really trying to convey that message to you all. Try to relax this month because the fall is coming up. It's probably going to be very volatile. So take that, as a means of being inspired to just pull back in terms of your activity and the fevered pitch that you usually try to go into looking for setups. So try to dial that back. I'm not saying there won't be movements in these markets. Just I'm not trying to push it hard right now. I'm saving my gunpowder for September, October, and November. All right, so let's take a look at the E-mini S&P hourly chart. Okay, and I'm going to kind of like break this down for you. Now, before I get into this, invariably, I'm going to have people that have not been following along, that did not watch the last week's videos before they were booked in price real time. Before you look at the tweets that I have on my Twitter. Okay, so everything I'm going to say to you here was before it happened. Okay, it was not both sides of the marketplace. And I'm saying this, and I know some of you are rolling your eyes like this is bragging. I'm not bragging. I'm answering the inevitable members that's going to come to this channel right now for the very first time. Like this is the first video they're watching. And it's going to look like I'm pointing to something that's already happened. And there was no foresight. When you all know that these things were talked about in videos before the actual day, and you can look at the YouTube channel and you can look at the tweets. Okay. But I mentioned how we were likely to draw higher, and those daily levels here, that 40.30 and a half and 41.07 and a quarter, those levels respectively are on. Let me go back up to the daily chart so we can get our frame of reference. That low and that high, that's the imbalance seen here. Okay, so we're likely to see the algorithm reprice higher now that it has offered sell side. Now buy side, it's repriced. It's not balanced yet. Okay, that is not balanced. We can come back down into half of that range and revisit this close of that candle. I would like that. And that would be beneficial really for it to come down here, maybe a little bit below that, overshoot, and then come higher to attack the buy side. I would like that and eventually gravitate to here. That's kind of like what I'm anticipating, but because we have non-farm payroll and it's August and it's the first week of the month, again, it's just an idea I'm watching to see if it pans out. I'm not going to go in here hard lining it and pushing it to make sure it happens in my own trades. This is something I'm just putting out there before it happens. If it happens, great. If it doesn't, I don't really care because, like I said, I'm not trying to participate that much this month. So we have those levels in mind. In this area down here is that fair value gap on the daily chart. Again, once more, I'm showing you back and forth so you can see. Here's that fair value gap between this candle's high, that candle's low. Right here, okay? Now into hourly chart, that's what we're seeing here. Now, I want you to think about how I teach intraday charts, very small time frames, below 1 minute time frame, 1 minute chart, 2 minute, 3, 4, 5 minute, 15 minute chart, 60 minute chart, 4 hour chart, and daily. Obviously, I've convinced a lot of you and converted a lot of the naysayers over the past 7 months, showing and showcasing a specific model I've taught in the 2022 free YouTube mentorship for the ICT mentorship series. Taking a step back and giving you the nuts and bolts as to how I called last week and how it delivered, I want you to understand some of the components here, because the algorithm isn't just running on 1-minute charts and 5-minute charts and 15-minute charts and hourly charts. It's really utilizing the daily chart. Okay, that provides majority of the bias, the buy sell programs that it enters. Okay, and what's a buy or sell program? A buy program is where it starts gyrating and moving towards a specific higher time frame PD array. And what's a PD array? It could be an old high, it could be a bearish order block, it could be a fair value gap that's above market price, it could be a bearish breaker. Anything above current market price that would draw price to it. Because we're looking at higher prices, and I outlined this last week, both in Twitter and on the YouTube channel, videos. Each day I was doing a market review. I was suggesting what I thought was going to happen to give you a taste of what it's like to be mentored real time before it happens. And you can see with visibility and a great deal of precision how these concepts work very well. And they're complemented when you have the student watching it real time with something in mind before it happens, not just pointing to something that's stale and that's already happened in the chart. So because I have the benefit of hindsight now, and I've earned the right to be able to talk about it now because I called all this last week, push all that to the side. If you haven't watched everything from last week, stop watching this video, go watch last week's videos and go through the tweets from last week, and you'll be brought up to speed. And this will be a much more meaningful lecture to you. But if you look at how we traded down into that fair value gap on the daily chart, we dropped down into it, and then we had a lot of animation to the upside, and then another run here, taking buy side and reaching into that lower level discount low of the fair value gap. Remember, this is the high of the fair value gap on the daily chart. This is the low of the fair value gap, both of those levels here, okay? So it reaches up into it, trades off a little bit, and I mentioned on this particular day, on the video on the 27th of July, 2022, I explained how the NASDAQ would draw back down into its imbalance. The S&P is going to do the same thing, folks. But I gave you a very specific target to reach for in the next day on the 28th, which was 40.75, which I'll explain why I got that level. And then I said 41.07 and a quarter. Okay, so by itself, that's enough. That's all you would need. One good, strong setup for the week. And that's how you build your business model. You go in looking for one solid higher time frame delivery, and you participate in it if you can. If it gravitates over a period of several days, then you day trade it. Small little pieces going towards that common goal of a higher time frame array, being 40, 30, 50, and 41.07 and a quarter. Now, these are the day dividers here. Now, I want you to think about, here's Friday's trading, Thursday's trading, Wednesday's trading, Tuesday's trading, and Monday's trading. I want you to think about how I was outlining and pointing your attention to how we were likely to go up to this level here. If we started the week here and we dropped down here, and I said, take your profits, cover your shorts below a specific price level, which I'll get to. I'll cover that in this lecture here as well. But if I'm saying, take your profits, pay the trader below a specific level on a specific day, and I'm also aiming your attention here and here, couple that together with a day of week. These lessons that I placed on this YouTube channel, and I have been teaching for almost 30 years now, that generally, if you're bullish, the markets tend to make the low of the week on Tuesday. Not all the time. Sometimes it's on a Monday. Sometimes it's on a Wednesday, depending upon the economic calendar. But generally, 70% of the time, yes, 70% of the time. Now, some of you in the past have gone through and looked at every time the market had a higher close than that of the open on Monday. You go right to see if Tuesday was the low of the week. That's not what I'm saying here. When the technicals are in alignment, and I'm calling the market higher, based on my concepts, my tools, and getting in alignment with the algorithm that runs these markets, that books price. And I know some of you don't like to hear that, but I'm going to show you even further evidence of that tonight. Tuesday generally has a 70% likelihood it's going to create the low of the week. So, Monday, not so interested in it because there's no real economic news. Tuesday, we had data. Wednesday, we had data. Thursday, we had data going into Friday. And we saw the objectives met on Wednesday and on Thursday. But let's take a deeper dive into all of this and how it fits algorithmically on the higher time frames. I want you to think about what you're seeing here. Now, this is not some kind of a triangle pattern for harmonics sake, okay? But this is the pattern that I used to teach my students when I was teaching one-on-one back in the late 90s, early 2000s. I do not do one-on-one teachings anymore, but just understand that this is the approach of what I did. There's an old low, a high, and a lower low that attacks that low. This is my ICT bearish breaker pattern. In this high up here, there's going to be something that's going to be used to act as real support. It is not the old high broken become support. It's not ceiling broken becomes floor. Okay, that's not how these markets work. I know everyone wants it so simple that it's just that easy, but you know what it was like the first time you saw that in books and videos on YouTube and people telling you this in Instagram teachings and Facebook teachings and workshops and such and webinars and things of that nature. All of a sudden when you went out into the live market, that stuff didn't hold up, did it? So I want to kind of like have you suspend your belief in support and resistance for a moment as well, okay? Understanding that this pattern here has to have the logic that you know because of higher time frame order flow, the things I've already outlined, and I'll give you more amplification of that tonight here. Things I did not cover, but I would draw your attention to because of we saw it pan out. And I'm going to give you more insight as to why I was able to tell you what I saw coming last week, and it came to fruition even in your own charts. We're looking for this level here and here. The market drops down here below that old low. There's an initial drawdown there. Why would it want to go there? Because the algorithm is allowing smart money to accumulate long positions right there. Now, smart money, that's an entity that I've been pushing for 26 years. And largely it goes unnoticed. It gets laughed at. It's misappropriated as, oh, he doesn't know what a market maker is because a market maker is delta neutral. No, that's a dealer. Okay. If you call yourself a market maker at a bank or an investment firm, you are a dealer. That's what you are. You're dealing with a price feed that you can't control. Hello. Market makers are the ones that deliver the price to the marketplace. There's a location where that arrives from that gets piped into the marketplace. All of these investment firms have an aggregate data feed that they're working within. Where do you think that's coming from? Right. See, that's the problem with everyone out there thinking that when I talk about market makers, they think, oh, he's talking about the Goldman Sachs market maker or the guy that used to do market making with options on the crude oil market. And that's not a market maker. You're a dealer. There's a difference. Okay. A market maker, and this is why you're never going to beat the market maker, folks. Okay. Despite the guys that took my 1996 lessons and lectures and added indicators to it and called it a beat the market maker system. You're not beating any market makers. Okay. You're not beating them because they're creating the price. They're setting the price. And then dealers deal with traders' order flow coming into that. But guess what? If a large bank comes in and says, we want this instrument to be priced here, it doesn't matter what your quote unquote market maker or what I'm telling you is a dealer is doing, taking counterparties, providing liquidity to traders in their in-pool liquidity. It has nothing to do, absolutely nothing to do with how a large bank can reprice these instruments. Now, it's more so seen in currencies, but the effects are still seen in these instruments as well. You don't have to believe me. In fact, I want you to have a little bit of healthy skepticism, because I want you to think about what I'm going to show you here tonight. And you draw the understandings of any retail logic that's out there and think about the sheer odds of all those things pointing to the very things I'm going to take your attention to tonight. It's laughable. Retail is not making these markets. Okay. So dealers are not making the markets. They're making a market for traders for that at market liquidity. But that is not making the market. When I say making the market, they're controlling these instruments' price all the time. Because if they weren't, we collectively could do what Reddit tried to do last year, laughably. They're going to muscle the market, and they're going to take stocks and push them to the moon and punish these billionaires. How'd that work out? You can't beat the people that have the commodity themselves. The instrument is theirs. A bank of a specific country, that's their commodity. That's their product. They set the price. You can't do anything to make it change. Okay. You may be booking a trade in between fluctuations that are happening at the market right now through the means of a dealer that everybody refers to as a market maker. That is not a market maker. Now, you can say, well, Michael, they're making a market for the traders in that specific time period. No, you're dealing. Okay, that's not a market maker. They may take the other side of that trade, but in these markets, currencies and equity futures, there's enough liquidity that the one dealer that want to be referred to as market makers at specific investment firms, they're not the only entity out there. There's enough liquidity to take the other side of that trade. So that's not market making in the sense that I'm saying there's a market maker that delivers price ultimately. Where does it begin? Where does price begin? That dealer has to operate in a price feed that it has absolutely no control of. Now, there has been instances where markets can be spoofed and manipulated, yes, but largely they're controlled above the Goldman Sachs level, above the Barclays level, above the Citi. That's what I'm referring to when I say market maker. When I say a market maker, I'm talking about in Forex and currencies, I'm talking about the actual central bank. That's the market maker. They're setting the price. And it doesn't care what your little trinkets are on your chart. It doesn't care about your harmonic triangles. It doesn't care about order blocks. It doesn't care about any of that. If it wants to reprice price higher or lower, several hundred pips in an instant, who are you to say they can't? Right. Who is Goldman Sachs that's going to say you can't do that? Bank of Australia. Really? They're going to say pound sand. Not that that actually goes on, but that's the equivalent of what would actually happen. The central banks are in control. Whether you like it or not, you are not beating them. So when we see the market drop down below this old low here, it's going down there algorithmically so the market can provide the opportunity for smart money to accumulate the resting sell orders that are below that old low. Why would they want to have an interest in that? Because remember, I already took your attention to that level here and that level here before the fact. That was the targets for the week. It just so happens that we dropped down on the day of the week, Tuesday. Well, that's the 70% odds of doing what? Creating the low of the week. Don't take my word for it. Look at the channel content on this YouTube channel. I teach that. Here is that low with this pattern, graphically describing everything that goes on, and it's going down right here. We're going to come back to this low in a couple minutes. But here it is, that low. I drew your attention to that very particular price level, 39.20. Now, I know some of you probably didn't pay that much attention to it. I understand, but I do not delete any tweets. I don't give two sides of the coin. I give one side. We were all looking here and here and 40.75. Sell side liquidity resting below that low. We drop down into that on Tuesday and accumulate those sell stops, buying sell orders. So you're taking the approach of smart money, accumulating what? The selling interest is below here. Who wants to sell below there? Anyone that went long and they put their stop loss below there. Why? Because that's support, right? That's what the books say. The books say, if the market's bullish, look where it bounced before. And if it starts to run away, put your stop loss right below that and trust it. And I teach you, look for that. That's your entries. That's your targets. There's a paradigm shift there. See, smart money does not look at charts and say where's support and where's resistance so they can buy and sell based on support being buyers and or resistance being sellers. That's not how they engage. They look for the retail perspective of how they're going to see price action like this. That's what separates me. That's why my analysis is so bang on majority of the times. That's why my bias is generally right. That's why my expectation what the algorithm is likely to do and where it's going to reprice to is generally about 90% accurate. And that's a staggering number for some of you that have never seen me operate, but those who have been with me for years know this is the facts. Now, putting that aside, because I know it sounds egotistical, because it's not meant to be egotistical, I want you to understand that I'm using data points that are linked to the algorithm. I'm showing you as much as I can show you, and I've shown you proof here again, that these things are unfolding because of the logic I'm teaching in this YouTube channel, in the mentorship, and in the future lessons. So we're seeing the market dive down on Tuesday, which there's a 70% chance that it's likely to create the low of the week. We're already bullish. We're looking for this level here, here, in this midpoint here. So the market rallies on Tuesday, and on Wednesday, we rally once more, and we create an imbalance. And I mentioned, because of that imbalance, we would likely see the market drop down into that imbalance and rally on the NASDAQ. But because NASDAQ and even the S&P move in tandem, the same likelihood of it drawing back down into the S&P should be expected. And I covered that in last week's videos. Now, let's scroll on back over here. So here's where classic support and resistance theorists will say, okay, here's the high where it stopped. So we have to put a line right there and draw that out in time. And if the market drops down into that, we can be a buyer. Well, what happened? Where's the support at? Sorry, support left the building like Elvis. And you have folks that say, okay, we have the bodies of the candles. That's usually a real classic retail advanced support and resistance theory. Okay, we're going to draw out the bodies, draw that out in time, and look at that. Went through that too. So that's not good either. So I already know some of you are thinking, oh, well, anybody can go back in hindsight and pick things apart. But I've had folks out there do that with me. But I'm actually teaching you, my students, what it's going to do before it happens. And it's happening like clockwork. That should encourage you. It shouldn't inspire you to go in and start looking for more things to doubt. I do these things to encourage you to keep digging into the things I'm sharing. Because if you can't see me doing it, then why would you reasonably expect to be able to learn how to do it? Because if a mentor cannot do it beforehand, call it beforehand, outline it with a great deal of precision, then they really don't know what they're talking about. And there wouldn't be an algorithm if I couldn't do these things before it happens, right? That's what I want you to think about. That's the takeaway. There's a real algorithm running all these markets. I don't care who tells you otherwise. Let them come to this channel and tell me why it ain't, and I'll do this continuously right in front of them. It is what it is. So the market drops down into the halfway point of that imbalance here, and the shaded area is over here. What is this? This is the very breaker, the up candle prior to the move lower, this bigger, beefier up close candle right here, that's what I'm looking at. Why am I not using this one over here? You could use it, but I like this one because this was the very last candle prior to a drop down. So this is going to be the bearish order block as well. But I'm not using the bearish order block for markets to see it go up here to sell off like it does there. That's fine. Trades down to the low of Tuesday. I'm not expecting it to hit that same level here again and sell off. See what it does here? It rams right through it. So in context, it was fine for a short here on a day we had really no real news. Dropping down into Tuesday, 70% likelihood creating a low of the week, taking sell side liquidity inside of a fair value gap on the daily chart. Other factors I'm going to show you in a couple minutes. Lots of things suggesting this is going to be low of the week. The market rallies and runs into the 40, 30 and a half level. Drops down on Thursday into the imbalance I mentioned. Inside this candle, so we have a bearish order block, which is a bullish breaker. Low. Reaccumulate more longs. Reaccumulate more longs. Delivery. So we're going to take a big step back all the way up to the weekly chart. Now here's that imbalance on the weekly chart. Okay. It's hard to see why it would be anchored to anything here on a weekly chart, but you understand because of what I've shown you in the lower time frame charts. So this down close candle right here, I like that because it has a nice big beefy body candle versus something like this. So I'm anchoring a level right there on that candle's opening, extending out in time. Watch what the next weekly candle does. Remember, I already told you last week that we were looking for markets to reprice higher. And this level here and this level here was the weekly objective for E-mini S&P. But it has to come down into a specific higher time frame PD array. What is that? The weekly order block. The market opens here on the week, trades down right into that level, then accumulates and sends it higher to the levels we were looking for and even further. Now, isn't that awesome? Look at that. You can't look at this as supply and demand because it didn't leave this area to come back down into it. It's in this area here. You see that? So we're looking through candles. We're looking through the logic that is prevalent with retail supply and demand ideas. And I know some of you like to use that stuff, and maybe you're attributing your winnings to that. But I promise you, if you go through what I'm teaching and look at when your supply and demand trades worked with the logic that I'm teaching, how the algorithm prices and books these markets, you'll understand why your winning trades won, and you'll more specifically understand why your losing trades lost. Big paradigm shift there for the people that had the courage to go into that. So here's that same level here, the weekly order block. It's anchored here. Boom. Tuesday. This is Tuesday, last week. Trades down into that low, into the fair value gap on the daily chart. That's what this blue shaded area is. Hits the weekly order block on Tuesday, where there's a 70% likelihood it's going to create what? The low of the week. We're aiming for this level, and we're aiming for this level, and we're aiming for this level. Zoomed in. Here's my tweet on July 26th, 2022 at 11:52 New York local time. Pay the trader under 39.20. 39.20. Look at the bodies of the candles. Digs into that fair value gap. The afternoon session creates one more pass through. The bodies never close below 39.20, and basically it just digs into that, and we're off to the races looking for the objectives I gave you for last week. 40.30 and a half, 40.75. Why 40.75? Because it's 5 points above midpoint, which is 40.70. So halfway between this level here and here, that midpoint, that's what I was looking for, an objective. And then I said if it goes there, it can act as support, which it does here, rallies up and hits 41.07 and a quarter. Handled. So the question is, why is price reacting at the levels that I teach you? Between this candle's high and this candle's low, midpoint of that right in here, off by 1/4 of a point. Find Wyckoff teaching that. Find Supply and Demand teaching that. Elliott Wave, harmonics. It's not there, folks. This stuff seems complicated because you have no rules. You've not been studying it. You don't know what you're looking for because you haven't been taught. I'm teaching you. I'm showing you beforehand that it works. And I'm not leaning on any other logic that anybody else can say they taught me or had in a book or in a course. So it's time to put all that stuff aside and just say, you know what? This man is willing to spend his time for free to teach you something you would have never learned. I'm telling you, folks, you would have never learned this. I had to create this language to get as close as I can to the algorithm because you're not supposed to know about it. And I know that sounds secret mystery man Huddleston doing it all over again. But guess what, folks? It is what it is. I would love to sit down and say, here's what the algorithm does and done. But I can't. So I have to give you a language to be able to see these things in price action so that way you can find these things that are repeating. There's many other things that are occurring. Lots of other things that I can trade with. But you're never going to learn those things. And I know some of you get mad when I say that. But here's the thing. If I'm giving you this, why would you want to do anything else? What do you need anything more for? You just need one pattern, one setup, one framework, one model. Sound money management to apply to that. And then, hey, you have a really good trading plan. Exercise sound discipline and personal responsibility. Couple that with seasonal tendencies and understand when to push it, when not to push it. August is not a month you want to push it. What does that mean, push it? Trade a lot. Don't do a lot of leverage. Do your trades with very, very small leverage. In fact, use the least. Try to aim for one setup a week, and when you get it, stop. Trust me, folks. That is the best advice I can give you if you're now just becoming good at what it is I'm teaching you. If you're starting to get a firm grasp on what it is I've taught, the worst thing you can do is go in here and try to push it because you think you're ready for it. And August is typically not a month. It is a very good market for booking very symmetrical price action. Sometimes there's a flurry of activity and action, but generally it's really a sloppy month. So expect that. Go on vacation. Take the whole month of August off. I'm taking half of it off. So if I'm taking half the month off, and I'm telling you, I've been doing this for 30 years, generally August sucks. Period. So your precision may be off. Your insights may be skewed. You may see something that may not really be there. And I'm certain, because I've watched some of the YouTubers that do live streamings, and they had a real hard time today. Because they're pushing it. They're expecting something to be there when it's really not there. That's wisdom. That comes from doing it painfully over and over again in times when it's not likely to pan out for you. And I'm lending that experience to you. I'm trying to give this to you, but some of you are resisting it. You're literally fighting me. No, screw you, ICT. Keep your money-making stuff, okay? You give it to me for free, so it must not be worth anything. So, just keep it, pal. Okay? Save it for somebody else, because we're not buying it here. Okay. All right. I understand not every one of you are going to warm up to me, but try trading. When you lose your money, come back to this channel, and I promise you, it will be like an old friend greeting you very warmly. That's all I'm trying to be, is a voice of reason. I can prove this stuff every single week. I can prove it every single day. I can push a button. I can do it with live accounts. I can do it with demo accounts. I can run up accounts big. I can do it in small shoestring budgets too. Pick your poison. I've done all that stuff. Now, things are getting hard. And you have no idea how hard it's about to become. Making money is going to be very, very difficult, and your jobs are not promised to you. Just because you show up every day, you're a model employee, it doesn't entitle you to continuously earn income. They don't owe you anything. So it's important for you to start working towards this skill set now. You have to have an alternative source. And it's not about getting rich. It's about making ends meet. Until next time, be safe.